y'all. So today we're talking about escrow accounts. And escrow accounts are probably among the most confusing aspects of a mortgage to explain to a client, but I'm going to try to do the best that I can. Remember, an escrow account is included in your mortgage when you're doing less than 20% down. If you're doing a down payment that is 20% or higher, you have the option of waiving your escrow account, and that comes with some potential impacts. Now, whether you should waive your escrow or not is for a completely different video, but conventional loans do offer that flexibility if you do want to waive it and are doing at least a 20% down payment. Now, for government loans, FHA, VA loans, USDA, you're going to be required to have an escrow account whether you like it or not. And so make sure that you kind of prepare yourself mentally for that. Now, what does an escrow account do and how does it work? So in order to first understand what escrow accounts are, we need to go back and start with the monthly payment. Now, the monthly payment is designed to allot for and to collect for things like your monthly principal, your interest, your property taxes, your homeowners insurance, mortgage insurance potentially. But when you make that payment, you're not actually paying your homeowners insurance or your property taxes. Remember, your homeowners insurance was paid in full at closing. So you're paid up for an entire year. And your property taxes aren't due until the end of the year, December, January. So when you're making a monthly payment, those amounts that are required or that are being collected for monthly property taxes and monthly homeowners insurance, they're being sent into your escrow account to save up and prepare to pay these premiums down the road. Let's imagine that you're purchasing a house in the middle of June. Let's say June 15th. Well, from the very start, we know that your next homeowners insurance premium is going to be due next June 15th, give or take. We also know that your property taxes are going to be due at the end of the year in December. So we have to be prepared to pay your full property tax bill, 12 months worth of property taxes, right, at the end of the year. But we also want to make room for changes in property taxes, which is generally why your escrow accounts are set up to collect with a buffer of about 2 to 3 months worth of property taxes and homeowners insurance. So if we're closing June 15th, we know you're not making a mortgage payment in June. You're also not making a mortgage payment in July because you're going to skip that month. Your first payment is going to be August 1st. So you will make a payment August, September, October, November, and December of that year. 5 payments, right? 5 payments worth of principal and interest, property taxes, and homeowners insurance. So we know that we're going to have 5 from you, but we want to make sure that we have 14. 12 months for your property taxes and a give or take 2 months. Now, some lenders may collect 3 months worth of a buffer, but generally what you'll see is that it's 2 to 3 months of a buffer at the end of the year for your escrow account. So if we need 14 months, right, at the end of the year, 12 for your annual property tax premium and 2 months for buffer, then that means at the point of closing, we know that we need to have an extra 9 months. The moment you close on that house, there needs to be 9 months of property taxes in your escrow account because you're going to make 5 payments in that year that will give us 14 by the time we get to the end of the year. And so you'll notice that the escrow account on your closing disclosures will have a huge collection for 9 months. Now, don't freak out, because if you're paying attention, you'll start kind of collecting the dots and saying, wait a minute, why am I paying a full year's worth of property taxes if the homeowner owned the home from January 1st through June 15th? And you're onto something, because what should happen on your final closing disclosure is that you should be getting a tax proration credit from the seller of that home to you at closing to pay for their portion of property taxes from January 1st all the way until June 15th, hypothetically in the scenario. So really, the only thing that you're paying into your escrow account is the difference, which is the buffer. Somewhere around 2 or 3 months is generally what you're paying on your closing disclosure towards that escrow account, because you're getting a whole bunch of money from the seller. You're adding your buffer, putting it into the escrow account to have 9 months at closing. Then you'll make your 5 payments so that at the end of the year, you'll have enough money in your escrow account to pay for your property taxes, and the seller has already paid their portion. Why does it have to happen that way? Well, it happens that way because lenders don't control the county. The county is going to come for taxes due for the owner of the home, right? When they get to sending out the bill, they're not going to bother with trying to figure out, okay, well, let me go after the old seller and ask them for half, and let me ask you for the rest. They're not going to bother with that. They're going to come to the homeowner and say, this is how much you owe. Right? It's our responsibility as lenders and title agents and closers and all of the people that manage the transaction to make sure that at the point of sale, you are getting the appropriate credits from the seller, and that we're also preparing your escrow account to pay the piper at the end of the year. And so the escrow account is really, really important. And it's very confusing to everyone because a lot of the times people think, well, I paid a full year worth of homeowners insurance at closing, and you're also collecting a monthly homeowners insurance premium. Why am I double paying homeowners? And you're not. What's happening is that you've already paid for a full year's premium, and the mortgage payment is collecting the homeowners insurance and the property taxes so that when they come due, the full premium is ready to be paid and withdrawn from your escrow account. And that cycle continues over and over and over again until you either sell or refinance the home. Now, the good thing that you should know is that the money that's in the escrow account is yours. At whatever point you sell or refinance the home, that money is refunded to you. So if you close in the middle of the year and your escrow account has built up and has a few $1,000s in it because they're getting ready to pay for property taxes, well, that money gets refunded to you. They cut you a check, the mortgage company cuts you a check, sends it in the mail, usually gets to you within about 3 or 4 weeks, give or take. But you always want to make sure and not forget that, because that's your money, and you want to make sure to capitalize on getting that check and putting it back into your account. So I hope that this is helpful. I know it's a lot, and believe me, I could have spoken for 20 minutes, 20, 30 minutes on escrow accounts. But if you have questions about your situation, whatever curiosity you might have, do not hesitate to call us, text us, email us. And please don't forget, like and subscribe this channel, share it with as many people as possible, and we'll continue to post as many videos as we possibly can to help educate you about the decisions that you're making about your mortgage. Thank you all. Have a great day. Peace.